Now to the retail shakeout. This earnings season has crowned some big winners and more than a few big losers. Joining us right now to talk all things consumer is Jan Kniffen. He's the CEO of J. Rogers Kniffen WWE. We got somebody behind us all morning, and it continues. Some of the fun.
The angel guy's not here.
No, the angel in a suit who had a rubber chicken with him, too.
Oh, he did?
Yeah, he did. Not sure where that was headed.
Yeah.
Jan, welcome. Welcome to the party this morning. Let's talk a little bit about what we're seeing right now with the consumer and the huge winners and losers in retail. I don't remember another earnings season where you saw these swings of 20+% in a retailer, in a series of retailers as they were reporting their earnings. I mean, this seems like everybody is on tenterhooks waiting to see how the consumer is holding up for each of these individual brands.
Well, that's kind of the stock market froth, right? But the retailers themselves reported not that exciting either way numbers. We saw a pretty solid consumer. If you looked at Walmart, the numbers were good, right? That's the consumer writ large. If you look at smaller pieces, even the Gap had good numbers. They're clearly coming back. Abercrombie reported good numbers. They're a company that hasn't been that great in the past either. So Dick's Sporting Goods reported very good numbers, considering it's a tough market right now for sporting goods. So if you look across the group, you certainly see plenty of people reporting good numbers. In retailing, we always have people that aren't winning, and we see that as well when we report. But if you look at what the consumer did exactly what they've been telling us. They're keeping the spending going. You can only stop them by scaring them really badly, and we haven't managed to yet, by shutting off their credit, and even at 21% short-term borrowing rates instead of 14.25%, which is what they had pre-COVID, we haven't stopped them there. And you can destroy their jobs. And very clearly, the job market's still pretty good, and people are still getting raises that stay on the job, and people that change jobs are getting better raises. Till some of that changes, this consumer is going to do what you heard a while ago when you talked about this is the roaring 20s. This is the roaring 20s.
I was just going to bring that up with you. This plays into what we heard from Ed Yardeni. He thinks that we're not mid-cycle. We're definitely not late cycle. He thinks this is early cycle and is going to continue for years. Would you buy into that in terms of what you follow with the consumer?
I've been telling you this is the roaring 20s since this started. And this is going to be that consumer because the same kind of things are driving it. You know, the roaring 20s were post-war and post a huge pandemic. And the consumer said, I'm going to wear short skirts, I'm going to go dance my heart out, and I'm going to spend money. And we're doing all the same things right now. And now it's just different because we're going to see Taylor Swift instead of going to some speakeasy someplace. But in fact, the consumer is reacting the same way psychologically. So if you're going to keep them from spending, you're going to need to hit them in the head with a 2x4, i.e. take away their jobs. And so far, despite what the Fed has done with crushing the money supply, and despite what they've done with quite high interest rates relative to pre-COVID, the consumer has just kept going. And you can finally stop them. If we keep rates high enough, long enough, we will slow down jobs. We will make it hard. I mean, right now, like I said, you're paying 21% for short-term credit instead of 14.25%. If you moved across the street and bought the exact same house you're living in, your payments would double. We know those things are there. The consumer knows they're there too. But they have basically said, as long as I have the capacity to spend, I'm going to. So now it's just a question of where do you spend it? And people like Walmart have said, spend it with me. I'm going to lower prices to you because I know you're struggling with this 20% higher cost that you're facing versus pre-COVID.
We don't have a lot of time, but you think Walmart is basically the best retailer out there right now. You want to explain why?
Walmart's the best retailer in the world. Costco's second. Home Depot's third. And Dick's Sporting Goods may be fourth. And I can explain that because Walmart has had the capacity to reinvest in their business, and they have done it all through COVID and right up to now, developing better technology to get the consumer in their store, to keep them in their store, and to give them a better deal than they've ever done before. And they're adopting AI faster than any other retailer, and they're making, therefore, their distribution system more efficient. And boy, when you're the biggest player and you've got the most money and you've got the lowest cost of capital and you're doing the right things, you and Amazon can sort of start mopping up the world. And they've done everything Amazon does, right? They put in Illuminate, they put in Marketplace. They've basically said, we are going to be just like Amazon, and we're going to be in 5,000 stores, and we'll be closer to you than they are. And it's a huge battle. And when elephants like that dance, people's toes get smashed. And we're seeing a lot of smashed toes.